the rule of thumb is very simple. If you can identify a company whose top line becomes its bottom line in a 5-7 year time period, you will make fantastic money. It's easier said than done. See, when a new sector is being born and the absolute size of the companies are very, very small, it's okay to overpay a little bit. As long as you believe that the sectors is going to become large, so there will be companies coming in aerospace, defense, and you have to keep an eye on them.
In unlisted, you're saying?
In unlisted, and they are going to come to the market.
But okay, I have to ask you this question. It's kind of like the elephant in the room. So it's your choice to address it or not. Waree Energies. Why did things go wrong, and what's the way forward?
What has gone wrong? I have no idea what has gone wrong. Is there something that's gone wrong?
The stock price has fallen
Stock
quite
price
a bit.
gone wrong has not. I think there are fears about Trump tariffs. There are fears about Trump being more in favor of fossil fuels and not being in favor of renewables. And I'm not saying it's not a valid concern, but that is the concern that is bringing.
Hey guys, I'm happy to be a part of Zerodha's media network. Together, Zerodha and I plan to bring to you simple yet effective and impactful news and views from the best minds in the financial world. Hey folks, welcome to the Money Mindset. Today I have someone with me who is known for his intensive research and analysis in the market, who's known for spotting mega trends, and someone who I've known for a very long time, and I'm very happy to have him on the Money Mindset today. Ravi Dharamshi of ValueQuest is here. Ravi, thank you so much for taking the time out.
Thank you so much for having me. It's definitely one of my pleasure to be here. And congratulations to you on starting this. I think it takes a lot of courage to step out of the traditional and step into the new. So congratulations to you.
Thank you so much. And it's been amazing, the journey so far, because I get to chat and learn from people like you. And in my earlier avatar, of course, it was a daily sort of, update
grind
on the market, the daily grind. But now we can spend some time and deep dive into research, into particular topics. But for the uninformed, ValueQuest is a platform that has grown from, I think, 20 crores to 20,000 crores AUM now. And the PMS has given a return of over 20% compounded since inception. And Ravi, you're very popular amongst the younger crowd. So everyone that I've asked has said, please ask Ravi his investment philosophy, and I'm here to do just that. But first you tell me, what is your worldview now, and what is your market view at the moment?
So the current worldview is quite hazy. There are a lot of imponderables and characters that are throwing a lot of uncertainty into the mix. So, but of course, if there is uncertainty and confusion around, that is bound to bring good prices. So from that perspective, I think it's a great point in India where in a mid-cycle of structural earnings growth, we are getting a great entry point. We are not facing any kind of a crisis. Our ability to absorb shocks as a country is far, far better. Our banking balance sheets are pristine. Our corporate balance sheets are pristine. So from that perspective, whatever it is, it's probably looking like a correction of the valuation, high valuation, which met with a sudden slowdown in earnings, which looks cyclical as of now. So from every perspective, India seems to be in a much better position. And I think it's a matter of time before we start our upward trajectory again.
So you don't feel that this is a bear market just yet?
I don't think so. My definition of bear market would be where, these small 1-2 quarters earnings slowdown become much more structural in nature. A P&L problem becomes a balance sheet problem. It becomes a more structural issue. Like we saw from almost 2010 to 20 for a 10-year period, we were putting in place IBC, the bankruptcy code. We were trying to correct our NPAs in the banking system. The kind of excesses we saw just prior to the global financial crisis, it took a lot of time for us to correct that. Nothing of that sort is happening right now. So it remains a structural uptrend, but we are faced with some temporary challenges of overvaluation and some slowdown in earnings, which we are going to grapple with. But I don't see it as a bear market for sure.
So the other day I was chatting with someone who said that this time it's different from COVID. You can't make those comparisons because in COVID it was a world issue where every economy got affected. But this time it's more local in the sense that, consumption is seeing a slowdown, inflation is hitting pockets, jobs are not that great in India. Do you agree? And if it is 100% local problem, then do you think it would take a longer for us to get out of this corrective phase?
No, I think I agree that it is more a local issue than a global issue. I think it would be 90% local and maybe 10% global. But the good part about it is nothing, whatever is the problem, cannot be corrected by a stroke of a pen. So, for example, I'll put it across that the reason I believe we are facing this slowdown is the government of the day has been excessively focused on fiscal consolidation. When every country in the world has been expanding its balance sheet, we have been contracting our balance sheet, which is the right path and which is the right thing to do. But it is a tough thing, right? When you're contracting your balance sheet, you are actually slowing down the pace. And last year, what happened because of the 5 month of election related moratorium on spending, suddenly we could see that this economy was running on only one single engine of central government driven capex. The consumption, the exports, the broader real estate cycle, they were just not picking up. The private sector capex cycle, all of that needs to pick up. And has government done enough to revive that? That remains a question. But I do believe that the problem is not lost on them. In fact, we could see in the actions taken, whether it was in the first budget right after election or in the last budget, the move is there towards one, the tax cuts were given, which means that we are focusing on reviving consumption. It's not only about teaching them how to fish, but maybe giving some money in the hands also. So because it's been almost 4-5 years since COVID, and we have not seen job growth revival, we have not seen incomes going up. So the discretionary power of a consumer has been waning for 4-5 years. So there is a need to pivot away from only focusing on capex towards consumption, and that pivot is there. Now, the other reason which I believe led to the slowdown is that RBI was excessively focused on inflation and managing the volatility in the rupee. They took their eye off the ball from the growth, and they probably kept the interest rates too high, considering that inflation was benign. I won't say it was very, very high. And secondly, they kept the regulatory very, very tight. The approach was usually, I think RBI has been a fantastic regulator, but I think in this particular case, they erred a little bit on being too overcautious. So now with the new governor coming in, he has reversed that for sure, whether in terms of addressing the structural deficit in the banking system or liquidity deficit, and second, in terms of the regulatory. Both of them are being now loosened up a little bit. In fact, I think he's really thrown bazooka at the problem. So we might overcompensate a little bit right for the moment, but I think that's a good thing. That means that puts, if those are the reasons, which I believe are, then that puts a floor to the market at some point of time. And since there is no balance sheet issue, there are no major global crisis happening anywhere, we are going to revive this. So again, problems are local, but problems can be corrected. The first step is recognizing that there's a problem, and this is the problem. Now that we have recognized this and we are taking steps, sooner or later we will be addressing those problems as well. I don't see them as a structural problem as of now, and it's harder to correct or any such thing.
So on top of the consumption slowdown, which in any case was happening, there is now this wealth destruction effect because of what's happening in the stock market as well, right? Do you think that would sort of compound the issue before it gets better?
No, so the rise in stock market also didn't impact the consumption positively, honestly. It did only to the extent of the $10 million houses being sold in Bombay. The real estate,
the top 1%,
the luxury end of the real estate in Bombay was doing very well, and maybe so in the 7-8 other top cities as well. But the broader real estate segment was suffering. Somebody keeps telling me, real estate friend of mine, he says it's easier to sell a 50 crore house in Bombay than it is to sell a 5 crore house. So,
but wait, hold on there. So that brings us to the argument that there is India and there is Bharat. Now India may be maybe okay going through a sort of a slowdown and maybe will recover, but there's this whole big Bharat, this lower strata of society which is really struggling, right? Do you think that that could take time, maybe 1-2 years to see recovery?
I think it's been already over 2 years. If you look at the way the quick service restaurant have reported numbers or the retail is reporting numbers, it's been already 2 years since we are reporting bad numbers on the consumption side. So can it go for another 6 months, 12 months? I cannot rule that out. But I would believe that incrementally now I would look for revival, green shoots. There are many things that have been done. So wealth the wealth impact is there as we spoke on the top 1 maybe 5% of the population, but for the 95% of the population what matters is the income and the job. So on that front, government has mandated that they are looking to build 3 crore houses. Now if they manage to do that, I think that will have a great multiplier effect in the economy. I think the best way to revive the consumption economy is to actually give boost to the household capex. And for that, you need to bring the interest rates down. For that, you need to incentivize, bring the real estate. RBI has brought the risk weight down for the real estate. Similarly, government has mandated to build those houses. And there are 200 ancillary industries around real estate which benefit whenever that revival happens. So, I think if we can get that going, we will manage to move a lot of population out of the agri towards more construction and real estate, and I think that would be a big shift that has a positive rub-off on the broader economy.
Okay. So, my main aim with this podcast is to pick your brains about your investment philosophy, because a lot of people want to know, how do you pick these mega trends? How have you managed this 20% plus compounded growth in your, in your portfolio since inception? So let me start from the start. What is your investment philosophy, and in a market like this, how do you approach things?
No, I think, Sonia, that's a fantastic question, but it is very important to understand where a person is coming from. Most of the time, there is so much noise and cacophony in the investment world is that people don't understand the background, the biases, the approach that one person is taking. So it's important to understand the investment philosophy of a person so that you can take what applies to you. Finally, in investment, it is about doing what is right for you, not necessarily that there is only one way to go about it. Okay, all roads lead to God, but you need to pick your the roads that you want to take. So what we try to do is slightly different than I think what most people out there do, which is be bottom-up stock pickers. We first try and identify where to fish in the pond. We believe it's all about improving your odds, about picking the right company. Now, if you want to pick the right company, first you have to pick the right sector. And if you want to pick the right sector, you have to pick the right trend, the larger mega trend. And then in that trend, you want to identify that inflection point at which you should be betting on it. Just because you know the name of a megatrend does not mean that you're going to be making a lot of money out of it. And I can explain that by example. But essentially, you need to identify that inflection point, because our investment horizon is 5 years. It is neither 10 years nor 1 year. So in the next 5 years, which are the sectors which will have the maximum the strongest tailwinds, we want to identify that, and then want to identify leaders, challengers or disruptors in that trend, so that they manage to change scale in that time period. See, the rule of thumb is very simple. If you can identify a company whose top line becomes its bottom line in a 5-7 year time period, you will make fantastic money. It's easier said than done.
Give me one example.
Okay, I want to resist taking names of companies, but in the previous bull run from 2003 to 2008, we have had many companies in the capital goods sector which started off at a revenue base of 300-500 crores, and in a 5-year time frame became 300-500 crore profit companies. So that is the kind of scale change. So, and if that happens, then you don't have to worry about all the noise about what is happening. You will make a ton of money even if you don't time your exits precisely. But second thing, you also need to understand, see, lot of people focus only on identifying companies that you can hold on for 10, 20, 30 years. Nothing wrong with that. As I said, there are many ways to skin the cat. But those kind of companies are very, very few and far in between. Probably there would be 20 companies in India who would have compounded their earnings at more than 15% for a 20-year stretch. There are not too many. But if you narrow it down to say 5-7 year period, you will find many companies that have, when I say many, it would be in hundreds, who have compounded their earnings at between 25 and 35%. Now that is a great pool to be, looking for, companies that can generate great returns. But you have to understand that not all of these companies will eventually sustain that kind of a growth rate. If not 5, 7, 9, 10 years, at some point of time that cycle will turn. So you want to ride that growth phase in that company, in that industry, and time your exit also accordingly.
So let me unpack a few things here. First, you started by saying that if you pick a mega trend, it's not necessary that the stock you pick will do well, and you said you'll share an example. What example is that?
So for example, today everybody knows that EVs are the way to go forward, surely. But why has then it not picked up till now? You need to go inside the reason. Will India take the EV route or will it go the hybrid way? We are not sure of that. So for us to pick that mega trend, there are certain preconditions. There has to be technological certainty, as in this is the technology that will succeed. There has to be unit economics which have to be in place. These businesses are making fantastic gross margins and there is a lot of value add over there. Then third, there has to be a scalable business model. Fourth, there has to be a regulatory tailwind to the sector, where government is actually coming up with regulations which favor the sector. They want to bring that supply, that part of the ecosystem to the country, and they are incentivizing that. Now, if you can have all those things, then you know for a fact that J curve adoption is around the corner. But in EV's case, for example, today 70% of the EV in a passenger vehicle is battery. The value of the EV is battery. Battery is all imported. We don't manufacture battery ourselves. Now, insurance companies don't know how to price that, because battery goes bad, your car goes bad. Now, if insurance is not going to back it, then adoption of the EV is not going to be so easy. Second, we don't yet have the charging infrastructure in place. Third, we don't know whether it will be lithium-ion battery or sodium-ion battery. We don't know, whether it will be hybrid or EVs. So there are many uncertainties surrounding the adoption of EV as of today, and hence it has not reached that inflection point yet where you can say that this mega trend is about to take off.
But why do you think India has not made progress in EVs for so many years at a time when China has not one but 20 BYDs or BYDs across the world and is giving competition globally? What is it that India is lacking? We have such amazing companies, whether it's an M&M, whether it's a Tata Motors. Why have we not made that progress?
No, I think we are, number one, we are a little late to the game. China is ahead not only of India, it is ahead of everyone else in the world. And in fact, BYD is giving Tesla a run for its money too. It's not only India. I think going into EV requires a lot of investments. There's a lot of technological breakthrough that we need. And everything said and done, Indian companies have not done that. Maybe it was because the regulations were not favoring that. But as a, I think, basic trait of our country is that we are a little always scared of change. We are not easy to adapt what is new. And it requires a leap of faith on the part of regulators as well as on the part of the industrialists.
It's like a chicken and egg situation.
Correct.
Yeah.
So, and honestly speaking, right now we are taking care of our basic needs, and I don't think we are ready for that kind of innovation that this requires. So, however, I am very hopeful. I think there is a startup culture being built, which is now focusing a lot on innovation. But I think it's a 10-20 year game. It's not like we are going to start having new cutting edge technology today. It will probably be 10 years down the line. But if we sow the seeds today, then we'll see it 10 years down the line. So yeah, I think those are the reasons why entire world is lagging. I won't say that only India is lagging.
Yeah.
Entire world is lagging in this space.
Yeah, okay. So that is established that EVs was one possible mega trend which didn't take off. So
Not yet taken off.
not yet taken off.
We
Okay.
need to see when the stars align, when everything falls in place, and then it might become a trend that takes off.
Okay. So the other thing you said is when you pick a company, you don't need to stick in it for, there are very few companies that have a compounding effect for 10, 15 years. So 5 to 7 years is a sweet spot where you get a large pool of companies, right? Then what? Once you identify, we'll come to the mega trends later, but once you identify a trend, you find a few companies that fit all your categories. First of all, what is the criteria? What are the top 5 or 6 things that you see in a company? And then how do you progress?
Yeah, so we have something what we call as scale framework. In that trend, when the trend adoption happens, then that J-curve adoption happens, what you want to identify is companies that are going to change scale dramatically. So it has to be a leader, challenger, or disruptor. So for that, we have a framework which essentially is a scalable business model, some sustainable competitive advantage, adaptive to changing market conditions, then a long runway, a large TAM, and of course a superior execution capability. So these are the things. It's essentially an acronym scale, which I just spelled out. But that is what we look for to say. Of course, then valuation is the other part of it. But to identify which companies will emerge the winner, we use this framework. And
so can you give me some examples? I mean, of course, we'll put a disclaimer that all of this is just purely educational and none of it are recommendations. But just for easier understanding of the viewer.
No, sure. So, for example, I think 3 years back, electronic manufacturing sector started taking off. We saw that Samsung came to India, Apple came to India. The ecosystem started developing around the electronic manufacturing, and the most basic component of an electronic manufacturing is the PCB board, the green colored PCB board, for anything that's electronics. And we could see that we have seen this shift happening from Korea to Taiwan to China, and we knew that this industry was going to become big in India as well. And we were starting off at a very low value add. So eventually we will go from assembly to components to the entire product to maybe even brand and IP. But that is a longer term story. Now we could see that this ecosystem is developing, and we needed to find a company that honestly we actually missed. The best company in the sector is probably Dixon. We actually missed that, but because we missed that, we were very keen on not missing the next one that was around the corner, which was Kaynes Technology. Again, disclaimer that we have actually exited the company as of today, but it's just being spoken about in the as an example.
Any reason why you exited?
I will come to that. But first, why Kaynes? It had a much broader portfolio of product. The cyclicality as compared to some of the consumer-facing companies was lesser. We would have visited every company in the sector. Many companies were coming to get listed, and we saw they had a far superior execution capabilities, kind of partnership that they had done, their ability to build adjacencies around. For example, when we invested, the semiconductor was nowhere in the picture. But now today, they are in the OSAT space as well, which is semiconductor assembly and testing. So that when you find a company that keeps expanding its TAM, is a superior execution, can get into partnership, and can grow its profit at a 35-40% plus compounding, then you have a winner at hand. So that's what we identified in electronic manufacturing. Sorry, you had a question.
Why did you exit?
So we have a rolling.
And the reason I'm asking you is because it's a disclaimer that even I had bought it in my portfolio, and of course now with the way the market has fallen, there is cracks. But I mean, as a retail investor, you sometimes just buy and hold it and expect that you buy at lower levels whenever it dips. Is that the right approach? And why did you exit the stock?
So as I said, we have a 5-year time horizon. So it's a time limited probabilistic approach. So what I mean is we have a rolling 5 years view. From this point on, next 5 years, from 1 year down the line, next 5 years, how it looks. And if in that time frame, if you can justify that this company can double its profits, and if I cut down the PE multiple also, and still I can make very good returns on it, then we continue holding. There came a point in time where it became very, very difficult to justify. I think when we bought it, we bought around 5% of the company on day one of listing. At that time, it was a 4,000 crore market cap company. We had something in mind that if this company does execute everything, whether on the PCB side or whether on the semiconductor side, it can possibly become a 1,000 crore PAT company by 28. Now, that was the kind of possibility that we were working with. Now, a 1,000 crore PAT by FY28, and if I give myself a exit P multiple of 30, market is giving it a 50 P multiple or 70, 80 P multiple is different. But if I give a 30 P multiple, I can justify a 30,000 crore market cap. Now, market in its own wisdom or folly, it gave it almost a 45,000 crore market cap. Now, there is no way I could justify a 90,000 crore market cap in the next 5-year horizon. Eventually, it might become. So, when you are faced with this kind of a situation, the only thing to do is exit out of it.
And not get emotional about it.
We actually exited much sooner. We didn't even wait for 30,000 crore. We exited at 25,000 crore market cap. It was a great winner for us. But that
you timed it well also, because then the stock fell after that, right? At some
it
point.
it went almost 70-80% higher from our exit price.
Oh.
Now it's
okay,
fallen.
bad timing.
No. I think it was great timing. You have to leave some money on the table. You will not be able to get it precisely right. You don't even have to try. But our reason for entry and exit is never the price movement. It is always the fundamental development. Price is only in those rare circumstances where markets make the valuation so crazy that it becomes untenable to be holding that company. So that was the rationale that we exited. We continue to like the space and the company, but I don't believe that as a minority shareholder, you are going to make substantial money in the next 3-4 years as of now. It needs to get far cheaper before you can start doing that.
Okay, wow, that's interesting. Okay. So you gave us the criteria and the companies that how you choose companies. The scale framework is what we were talking about. Okay, so then once you identify, then how do you move forward?
No, so I think the most
where does all of this come in? Like corporate governance issues, debt, promoters. Moat of the company. How do you decide all that? Does it matter?
No, of course it matters. When in our scale framework, S is scalable companies, and which are the scalable companies? Companies that have good governance structure in place, have strong balance sheet and cash flows, and a management that can execute your vision. So those things play a fantastic role. In fact, if I were to very, very simplify it, any opportunities can be broken down into 3 things only: business, valuations, and management. That's it. There is no fourth thing to it. Then it is everything else is about you, on how you go about doing this. So in management, we do have a framework where we try to use to see whether that management is up to the mark or no. So we judge their competency, we judge their capital allocation, we judge their alignment with minority shareholders, and everything can be judged on the last 20 years. If you take out the last 20 years financials, you will be able to see how they managed the previous downturn. Did they take any steps which are anti-minority shareholders? If there was a problem, what was the problem? Did they recognize it and correct the same? What kind of capital allocation decisions have they made in the past? It will give you a very good gist of the culture of the company, the competency of the company, and that is what we look for. And of course, it's an art; it's not a science. Once in a while, we will also end up making a mistake despite everything. But I think most of the time, you have to say no rather than yes. You have to be skeptical about things and people, and question everything before you place your bets.
So, a lot of people teach us how to buy and when to buy, but nobody teaches us when to sell. And you gave a very good example of Keynes, where you missed a large part of the rally, but you still sold because valuations became uncomfortable for you. Any other examples, can you tell us how do you decide when to sell a stock? Examples of the past.
Yeah. No, so I think there are 3 times, most wise people say there are only 3 times when you should be selling a stock. One, when market has gone crazy. 2 is when the company or the promoter has gone crazy. And when I say that is when they are raising capital or doing acquisitions which don't make sense, or taking on excessive debt, various kind of things that they are doing, which means they are gone crazy. And the third is that you have a far superior opportunity to invest
Elsewhere.
elsewhere. So that's a switch call essentially, and
In the same space.
not necessarily in the same
Okay,
space.
okay.
Better use for your capital.
Huh.
Those are the only three reasons when one should be looking to sell.
So can you give me an example of when a promoter has gone crazy and you've decided that, okay, now I need to move out?
No,
I mean, not crazy, but okay, like promoter has sort of shifted gears. Like suddenly, you know, there's some intercorporate transactions happening or transfers happening. Like something that has made you say, okay, now this is the alarm bell and now I need to exit. Just with an example.
So I will not give you an example of company that I have invested in, but I will tell you one recent decision of one of the new age companies. It's a insurance broking company, and it decided to enter hospitals. That doesn't make sense to
Which
me
one
at all.
is this?
Policy Bazaar.
Okay, huh. Okay, yeah.
So I don't know what competency they have in running a hospital, or how is this a forward integration. It doesn't make sense to me. Maybe it makes sense to them, and only time will tell whether they were crazy or I was crazy. But this seems to be a total diversification of wars, as in not the diversification, but it's
Got
some wrong capital allocation seems to be happening over here. So just an example, but again, please, all kinds of disclaimer. We don't own the stock. We might not own the stock, but
Sure.
yeah.
No, it's great for understanding. I mean,
Yeah.
it's an easier way for the investor to understand.
Yeah, I mean,
What to
it
do.
just doesn't make sense why a insurance broking company would get into hospitals. So maybe they have a good reason for it, or sometimes
But
they
maybe
make.
because they have tie-ups with certain hospitals anyway for insurance and.
But you have to see what kind of capital you are allocating. Your balance sheet size is X, and if you are
Yeah.
going to put a large part of that into a totally unrelated business,
and they don't have the expertise to run hospitals also.
so what is your right to win over there? What exact problem are you trying to address? Lot of questions over here, and until proven otherwise, I would say this is a definitely a wrong capital allocation.
Okay, so you said 3 reasons why you should sell a company: when the market goes crazy, when the promoter goes crazy, or some random decision is taken, or when you find a better opportunity.
So we discussed the market goes crazy in Keynes.
Yeah.
We discussed the promoter goes crazy
in a Policy Bazaar.
Policy Bazaar. And now
And the third one, when
is
you
a
switch.
much bet available to you. So
But when you
that's
say
a switch
superior,
call.
it's
Yeah.
more like a valuation call.
No, not. It's a combination of
Valuation
the
and
business outlook and the valuation. And basically, in the existing holding, if you're going to make 15% compounded, and you find a bet where you're going to make 30% compounded, I mean, it's a far better use of your capital. But over here, we don't try to be very cute. A 15% and an 18% is not a justifiable reason to make a switch. It has to be a far superior, because you have to factor in for the fact that you could be wrong. You could be wrong in the company that you own, and they might not do 15%, but they might do 18%. And you might be wrong in the other company where it might not do 30% but do 25%. Still, that 18 to 25% gap is enough for you to justify making that switch. So it has to be a far superior growth profile company, quality of company, ability to deploy capital. All those things come into picture when you make that kind of a switch.
So you want to give me any examples there where you took that call, like moved from one company to another purely because there was a huge valuation differential or growth differential?
Sure. In liquor industry, we used to own United Spirits. We used to own, it was McDowell back then, when it was still owned by Mr.
This
Mallya.
was way back.
Yeah, it was still owned by Mr. Mallya. And when Diageo came in, so this was the time when most people thought it's an MNC coming in. So it's actually a far superior bet now.
I remember that time.
As compared to what it was back then. But we had a slightly different view. So the business that was left behind by the promoter was decked up much more than what the MNCs would have known. That was number one mistake. Number two, they are not used to doing the business in the way an Indian promoter can do. And it would be a long drawn journey for them to turn it around. For example, it's a state subject. Every state has a different way of working. So, and in their need to keep everything above the board, from Diageo's perspective, they would let go of a lot of markets. And that would mean that there is at least a 3-5 year period where the company is not going to do well. And as I mentioned, our horizon is 3-5 years. So that did not make any sense for us to stay invested in that. Now, this was around the time when Radico was a very small company. It had a lot of problems. It had more than 1,000 crores of debt on books. There were some issues related to corporate governance in the past, some corporate deposits and everything. So, and again, this was a business, honestly, where the way this business was done, you could not rule out a lot of underhand dealings. So many issues around that, but there were few things that we noticed. Number one, that UP was its biggest market, and UP had just undergone a dramatic change in its excise policy. From very high, they cut the excise policy by 25%. Second, there used to be a monopoly of distribution over there, and that monopoly was broken and it was given away to 500 distributors. Now, what that will do is it will actually bring on books a lot of the sales which were not being shown. Basically, liquor industry in UP was being used as a conduit for making money flow through to the political channels. And now that was broken, and that money will actually come onto the corporate books. And so that was another thing. And third, because of the space left by the leader in the space, they will have a clear
larger
run.
Market.
They will have a clear run in grabbing the market
But
share.
you were okay buying it despite it having such a big debt?
Yes, as I mentioned, if that debt can be repaid through the cash flows of the business, yes, it is okay. We don't go for turnarounds, and especially balance sheet turnarounds, where you have to do an asset sale or some other kind of things, restructuring, to bring that company out of problem. So over here, what we saw is that the cash flows of the company were strong, and in a 3-year time frame, and they would repay a lot of that loan, and they actually ended up doing that. In a 2-year time frame, I think they brought the debt down by 70-80%. There was a realization on the part of the promoter. In fact, at that point of time, there were talks that they might sell out to Suntory, the Japanese maker, but they did not. They chose not to do it, and they instead chose to revive the business. That tells you that they thought the value of the company was much higher, and they wanted to revive the company. So your interests are aligned with the promoters. So that was also very important, that you need to have the interest. If they are looking at creating a value or a market cap for their own company, then you are in safe boat. So that was a big switch that we did, and it worked out well. This one was within the industry, but it's not necessary that it has to be within the industry.
Okay, that's interesting. So now finally I've got my question answered, that when do you sell a company? Because this is a question I've been asking so many people. There's so many random, of course, everybody's framework is different, but I'm glad to understand yours. Now I want to get to the meat of the discussion, which is what are the mega trends that you see over the next 5 to 10 years. And I do know that you have, you've spotted many mega trends in the past, whether it's energy transition, you're very big on defense. I want to talk about them one by one, but first I want to open the floor to you. What is the big mega trend that you see over the next 5 years?
So, Sonia, I'll just correct. If you ask the mega trend, there are many mega trends, and we'll be out of time discussing all the mega trends. But what we need to focus on is which are the mega trends which have reached an inflection point.
Correct.
Then that is a better way of saying, because everything is a mega trend, right? Whether it is EV, hydrogen, sustainable aviation fuel, solar, wind, nuclear, defense. Everything is a trend in its own right. The move towards energy transition is the larger encompassing theme, but every sub theme within that also has its own inflection point. And identifying that inflection point is more important than saying these are the themes. Because our approach is next 5 years. Next 5 years, where is the place that you will make money? And that is what we want to focus on. So from that perspective, I would say defense is slightly, the inflection point for defense was actually in 2020. And it's not today. But I will just explain how we got to this thing. So we started tracking defense as a sector since 2014-15. Prior to that, defense was not a sector in India. Okay, when we came, and there would be no sell side research analyst who would be tracking these. The companies were quoting at 10-12% kind of dividend yield. All public sector companies, nobody was interested in investing in them. But in 14-15, when Modi government 1.0 came to power, they started talking about Make in India. At that point of time, India's defense position was quite precarious. We had inventory worth 7 days. So if we got into a war, we would not last 8 days. Plus, all our defense equipment was imported. So we were heavily dependent on other countries for defense equipment. So there were the need to indigenize the defense production and to increase the production to meet the needs of the armed forces were very, very strong. But there were lots of problems also with the industry. It is an industry totally B2G, so it is dependent on government finances. And if government finances are not in good shape, then government spending will be lower on that sector. And so the orders won't come in.
High receivables.
The money will take longer time to come. All those kind of problems were there. Then because we had never encouraged the local production, there was no supply chain available to procure locally. You don't want to arm your forces with a subpar equipment, right? You want them to be as good as the enemy's equipment. So if you are not going to be able to procure good quality equipment from local manufacturers, then you have no choice but to go abroad. So I think government spent 5-6 years getting all those things corrected, and finally in 2020 they came out with a defense acquisition policy which replaced the older offset policy. There was an offset policy which actually mandated that 40% of your production should be locally done. But all the companies were circumventing that by doing very, very low and menial work over here, and actually they kept their IP and the value add everything abroad. So that policy was a failure. But when DAP 2020 came, it laid out the prioritization and the sequencing of how the procurement should go about happening. First, you have to buy only from an Indian company, Indian design, Indian manufactured equipment, if it is on par with the world. If that is not available, then you go to an Indian manufactured company, Indian design, but a foreign partner. Then you keep going that way lower. Now, so that was, but even that was not enough, but we followed it up with import embargoes, essentially banned.
This was around 2020.
2020. And that banned, we came out with a list of 100 items which could not be procured by imported manner. Now that is what changed. Now the armed forces had no choice but to procure locally. What that means is suddenly the inquiries started becoming orders and the visibility started growing, the order book started growing. So a business that was mediocre in terms of growth and visibility and in terms of return ratios suddenly started becoming a high growth and a high ROC because the payment cycle also reduced. So that was that inflection point in defense which kind of took off. But this was an inflection point only till now, only for the public sector, because it was primarily a public sector. I mean, today for procuring light combat aircraft or helicopter, you have to go to Hindustan Aeronautics. There is no choice. They are the monopoly over here. So similarly, others also. Frigates is manufactured only by Mazgon, or radars is manufactured only by BEL. So
and all these stocks have been big.
So this is only PSU. The private sector is now going to come into the picture. So
like the Bharat Forges of the world.
So these are all lead system integrators. Now, the way this business works is the lead system integrators gives it to a sub-assembly guy. Sub-assembly gives it to the component guy, the orders, and so on and so forth. The chain keeps expanding, and all the entire supply chain over here will be private sector. So these companies who are catering to the defense demand and are in the private sector are suddenly now seeing flux of orders, because all these HAL and BEL of the world are flux with orders. They are passing on the orders to the smaller guys, and these guys have never seen this kind of orders, and they need capital to grow from here.
Like which are the names?
So all these companies are essentially in the private sector. They are not yet listed. So from a private equity perspective, we are looking that as an opportunity, because what inflection point panned out in the public sector 4 years back is now going to pan out in the private sector, and these companies will all come to the market to list over the next few years. Some of them are already listed. It's not that no companies are listed. Companies like Data Pattern or Astra Microwave or something like that. But there are many more companies that will emerge out of this table, and I think that is one inflection point that we can see right now.
So, do you believe that this rally we've seen in the PSU companies has matured? I mean, the HALs, the Mazgaon docs of the world, or do you think that there is still more to go?
No, as a sector and as an opportunity, they still have a good 5 years ahead of them. However, incrementally, their monopolies and their complete control over the supply chain is going to reduce, and more value is probably going to be captured by this private sector than by the public sector. So I would look at these public sector defense companies more as a compounders from here, at a steady rate, at a slow rate, rather than a big, the kind of run we have seen in the last 5 years is not going to be repeated now.
So you're saying the main opportunity is in the private unlisted space. But
Yes.
for a retail investor who's watching you right now, how does he capitalize on that?
So keep looking out for companies that come in this sector. They will always look very expensive. See, when a new sector is being born, and the absolute size of the companies are very, very small, it's okay to overpay a little bit, as long as you believe that the sectors is going to become large. So there will be companies coming in aerospace, defense, and you have to keep an eye on them.
In unlisted, you're saying?
In unlisted, and they are going to come to the market now. Even in aerospace, for example, post COVID, what is happening is that the world, this supply chain was essentially based in US and Europe. See, this is one area where companies won't go to China because they don't trust that China will not take their IP and create weapons or whatever technology for themselves. So they are actually scared of putting their supply chain in China. So this is a great opportunity for India because people have just not come back to work. Now this is a very skilled labor intensive business. It's not only machines and robots. So whenever skilled labor is involved and at such a large scale, and now Europe is aging, and they don't want to come back to work. After COVID, they have realized that who knows how many more years I have. So I would rather enjoy my life, and that is actually impacting the sector, and they are looking for an alternate supply chain, and India is the perfect place. Indian market in itself is also expanding in a big way. We used to be 200-300 aircraft market. Now we have become a 1600 aircraft market with a huge, still lot more aircrafts to come. So the MRO business will expand. The servicing, the tooling, the equipment, the component, every entire ecosystem is going to develop in a big way over the next 10 years, is what I believe.
So you want to share some names with us in the unlisted space, or?
Again, a disclaimer that we have invested in a company which recently got listed called Unimac Aerospace, which is essentially into aerospace tooling. But again, disclaimer, we could be selling next moment we know.
So I want to talk about that because there was a viewer query that came in to elaborate on Unimac, and I haven't tracked the company. So has it fallen recently or something like that?
Everything has
fallen. Yeah, that's true. But I mean, for people who are, there's sort of coattail investing, right? That happens. I mean, Ravi has bought Unimac, so I'll also go ahead and buy. But then the stock starts falling. So what's your view now on Unimac?
First, I'll say on the coattail investing, I think people who are doing that, be very careful. I owe no responsibility to your actions, and I can change my opinion and do whatever I feel like. Also, the kind of conviction and that I have comes from my own work.
Also risk-taking.
It capacity. You will not be able to replicate that. You will not be able to have that kind of conviction at your end. So I would say avoid doing the coattail investing. Coming back to company, I mean, again, sorry to say, but I would not like to go deeper into it because it's a company that we own currently, and we can avoid talking more about Unimac.
Fair enough. Now, anything more in the defense space that you want to talk about? I mean, you've of course spoken about how there's so much potential in the unlisted space, in the private sector, but anything that in terms of valuations, how do you sort of value the defense companies and even the listed PSU guys? At what point do the valuations become uncomfortable for you? What's the cutoff?
So, see, a lot of people tend to think that P multiple means valuation. It is a metric of valuation. It is not the only metric of valuation. There are many metrics of valuation, and which metric of valuation to apply at which stage of the company, of the industry, of the growth journey is where the art lies. It's not simplistic like 20p multiple is cheap and 30 is
40
expensive.
now,
That
yeah.
it does not work that way. I can make a case for 5p multiple company can be very expensive and a 50p can be very cheap. If it is an industry which is just taking off, where there is going to be a large change of scale, and that's what we tend to gun for. If there is going to be a large change of scale and the business economics are attractive, that companies do make fantastic margins, return on invested capital, and the growth is very high, then these kind of industry tend to get overvalued even more, even further. And of course, growth plays a big role in that. Company growing at 20% versus a company growing at 30%. The 30% company can end up getting a 50p multiple, and a company growing at 20% might get a 25-30 multiple. So growth and ROIC both, and ability to deploy more capital. The FMCG, for example, is a great business, right? There is hardly any, it makes fantastic ROC, almost infinite. But the ability to deploy more capital in that business is very limited. So if you find businesses where the ROCs are improving, but incremental ROCs on the incremental capital deployed are growing even further, then that is your recipe for making fantastic money in a 5-7 year kind of a time horizon. So we look for companies that have the opportunity to deploy more capital, where they will be earning more ROC than what they are earning right now.
Okay, that's interesting. So one mega trend that you spoke about is the defense space and the private sector, how it's just sort of now, coming to fruition. Let's talk about the other mega trend. Of course, I'll allow you to elaborate, but energy transition is a trend that you've been speaking about. You wrote a fabulous report on that. I want to know a little bit about how that trend is going to play out. What are the different spaces in that trend? And for someone who's not participated in energy transition yet, how do they approach it?
No, thanks for that question, Sonia. I think ValueQuest has kind of gotten associated with this particular trend because I've spoken a lot about it.
Yeah.
But what is energy transition? It's nothing that it has not happened in the past. Humans have evolved from creating energy out of rubbing stones to finding fossil fuels, and our source of energy has kept on changing through the history of humanity. What is different this time around is, most of the time our sources of energies have been natural resources, either coal, natural gas, crude. So digging it out of the earth and burning it has been the only way we have gotten energy. But now the sources of energy are changing. It's wind, solar, nuclear, biofuels. Now these are all, one, they are renewable sources, and second, they involve a bit of manufacturing. So whenever there is a manufacturing involved, there is something called as learning curve. What I mean by that is, when you are digging, let's say, crude out of the oil field, your cost is, let's say, $10 to remove that crude. As you keep digging more and more, the level keeps going down, and then your incremental cost actually increases as it goes. So now the cost is $15, now the cost is $20 as you keep digging more and more. In this particular thing, it's actually the reverse. As you keep manufacturing more and more, your costs keep falling. So if you have seen in the renewables, the way the prices have fallen in solar, they used to cost some $2.50 per panel. Now that cost has fallen to 10 cents or even less than that.
Why does it fall so much?
Because you keep improving on the technology and your manufacturing efficiencies. So which is not the case in natural resource based energy source, right? So your cost of generating power incrementally will keep reducing. It will fall even 90% from here over a 10-15 year period.
Wow.
So
profitability of these companies will go up.
But lot of people think because the prices are falling, the profits will fall. But that is not the case. What you need to focus on is the spread. If your the realization is falling, along with that, is your cost of producing that is also falling at the same rate or no? And if you are able to maintain that spread, then your profits are not falling. In fact, your absolute margin is actually increasing. So I'll just explain with an example. Earlier, you used to make 5 cents on a 25 cents. So that's a 20% margin. Now you are making on a 10 cents, you are making 3 cents. That's a 30% margin. So that your profitability has increased. But of course, now you need to do lot more volumes.
This is solar you're talking about?
Solar is the trend that I'm talking about. So there is a learning rate involved which keeps pushing the cost down and down. So we are, this is a one large shift happening. Other thing that is important to note about this trend is that these earlier transitions have been more gradual. They happened where coal went on to become almost 40% of world's energy basket, but it happened over a 50-70 year time frame. This particular shift is happening, is going to go from currently we are at 5% in terms of renewables, we'll go to 70% in next 20 years. So it is not only a bigger shift, it is in a much shorter time frame. Wow. And there is a manufacturing piece involved over here. So if you understand that, then you know that there is a chance to make money over here. People from the old analysts will be focused on only the way the business functioned in when you are mining or removing coal and all that. But this requires a slightly different mindset. It is a manufacturing revolution along with the energy revolution. So
when you talk about manufacturing revolution, you're saying technological revolution.
Yes, technological revolution. Because see, it's solar panel is not new. It's been around for 70 years.
Yeah, I know.
It's only when
I have a solar panel on my terrace. I put it like 22 years, 23 years ago.
But it needs to hit that technology inflection point, the cost curve, and that certainty has to be there, and that regulatory push has to be there. That's when that mass adoption happens. And that is exactly what is happening in solar renewables today. Okay. There is regulatory push. There is not going to be major technological shift happening. A lot of people are worried about the technological shift. I mean, we'll go from one technology to another technology in a 5 years time frame, but by that time the companies would have sweated those assets, and they will also get the view of which technology is coming, and they will make that shift themselves, and they will use the cash flows from the previous technology, and they can upgrade their existing capacity. So it's not going to be a disruptive kind of a technological change that is going to happen.
So in solar, where is India currently as far as the J curve is concerned?
We barely began our journey, I think, in April of 2024, when finally the ALMM and BCD came into effect.
What is that?
The approved list of module manufacturer and basic customs duty.
Okay. So you have to explain to me like I'm a
10
10-year-old child, because I really don't understand.
So basically, we are providing an ecosystem of protection for the domestic manufacturers so that we can create a supply chain of our own. A lot of people are questioning, and why should we do this? Why should we not do this? We have protection in autos, we have protection in steel. Had we not given them protection, these industries would have never developed in India. Now, look at the strategic significance of this particular industry, solar. It is an industry which will give us energy independence. We will not be dependent on the oil producing nations for our energy needs. It will give us energy security. During the times of COVID, Europe was in for a rude shock when Russia stopped natural gas supply.
Yeah.
Now, in 10 years time, in 15 years time, India will not be dependent on anybody else for its own energy needs. We have enough of sun, we have enough of wind, and we can generate our own energy. So it carries a lot of strategic significance. Now, we don't want to make the same mistakes. I mean, okay, while in the fossil fuels we were unlucky, we don't have oil of our own.
Correct.
But in this case, we would be making a strategic mistake if we continue depending on China for our strategic needs in this sector. And the world is dependent on China. I mean, 95% of the value chain is China. So that dependence has to come down. So
in solar, you're saying?
In solar. So solar has, the value chain looks like this. There is polysilicon, then there is ingot, wafer, cell, module, and then the final panel. So this is the entire value chain, and what the government of the day is doing, it's starting with first the module where they are providing protection, then they are moving to cell, then they will move to wafer, and eventually to the entire supply chain.
So when you say protection, you mean like
tariff barriers and non-tariff barriers. You can buy only from the approved list, and if you are importing, then you will have to pay higher. So both the things are giving the industry enough protection for them to generate profits so that they can invest in the backward integration of the
And
thing.
this is for the domestic
Yes,
market.
yes, for the domestic guys. So now, it's a sunrise industry. The mega trend is that we are moving away from fossil fuel towards renewables, and within renewables, solar is the largest piece.
Correct.
Not nuclear. Nuclear might be the cleanest source of energy or the best source of energy, but it is not likely to become the biggest. The reason being, there is something called as you need to have affordability, acceptability, and awareness. All three things have to be there for that technology to get adopted. There is something called as NIMBY, not in my backyard, is the what everybody is suffering from. If tomorrow somebody says that I'm going to put up a nuclear plant behind your house, you're going to say not in my backyard. Exactly the thing. Nuclear might be the best source of energy, but costs are high. Technology is, it has side effects. It might be very small in terms of, the probability of that happening. But we have seen what happened in Chernobyl. We have seen what happened in Japan, Fukushima. So those things scare people, and that is why that technology will not become. Will it go to being a 5% of India's energy basket with this 100 gigawatt plan? I think it will. 100 gigawatt by 2050, if I'm not wrong, will still be 5% of, or maybe somewhere between 5 and 10% of India's energy basket. So it will never become much larger than that. So solar is going to be the biggest over here. So now you have a confluence of megatrends. One is the energy transition megatrend, within which solar fits in. Second, you have the megatrend of manufacturing supply chain shifting away from China towards India or other countries. And the third, in general, I think there is a manufacturing revolution happening. So, and these companies are at a confluence of all these three mega trends. So they are going to turn out to be a big beneficiary of that. And scale change, again, we are coming back to the same thing. One of the companies that we invested in this space used to be a 70 crore profit company.
Which one is this?
And it's going to end up being anywhere between 4 and 5,000 crore PAT company in 3 to 5 years time. So that kind of scale change is not easy. How many companies do you think in India there are who make more than 2,000 crores profit?
200?
Less than 100. And more than 5,000? Less than 20. When you...
No, in the listed space?
All companies, across. Listed, unlisted, all combined. If my data is primarily listed...
There are less than 100 companies making 200 crore profit?
2,000.
2,000 crore profit?
2,000.
Okay.
Now, if there are such few companies who can achieve this kind of scale, then obviously you need to give it a different kind of importance. Again, I will not name any company, but there are enough companies in the solar. Some of them got listed very recently.
You can give us some examples. We've already given the disclaimers multiple times.
No, so again, you can see all the data is public out there, which companies we have invested in. I won't name the company, but I'm just talking about the kind of scale change possibilities over here. And I think people are underappreciating that tremendously when they focus on one aspect, that it is a commoditized industry and it is making profits only because government of India is providing them protection. They don't understand the reason for that, and I think that is time will tell what holds true.
But that's the conviction that you have.
Yeah.
But okay, I have to ask you this question. It's kind of like the elephant in the room. So it's your choice to address it or not, Waree Energies. And I remember this was a company that you spoke about in one of the presentations which you had done about a couple of years ago. It was unlisted at that time. Huge potential, did very well on listing. But now the story has turned on its head in the last 6-8 months. Your thoughts, because a lot of investors, like I said, right, a lot of investors look up to investors like you and sort of take that call. But what is your theory? Why did things go wrong, and what's the way forward?
What has gone wrong? I have no idea what has gone wrong. Is there something that's gone wrong?
The stock price has fallen
stock
quite
price
a bit.
Gone wrong has not. I think there are fears about Trump tariffs. There are fears about Trump not being in favor of being more in favor of fossil fuels and not being in favor of renewables. And that is I'm not saying it's not a valid concern, but that is the concern that is bringing. Now, over there, I believe, as I mentioned, there are 3-4 things that we keep tracking: technological technological certainty, unit economics, then regulatory tailwinds, and the scalability of business model. Out of these 4, regulatory tailwinds is what we are questioning in one geography in US. Okay, rest of the things are not changing. It remains technologically. Solar is the cheapest form of energy that has ever been produced by humans at a mass scale. So the adoption of solar is not going to go down worldwide. Can it have a slowdown in US for 2-3 years perspective? That possibility, I don't rule that out.
Because of Trump's regulations.
Because I mean, we are still not sure which way he is leaning. Because for him right now, drilling more oil is a priority rather than saying solar, don't produce solar. He's more anti-wind than he is more anti-solar. India is not a priority for him. China, Mexico, Canada is a priority for him. So we are right now sitting in a corner unnoticed, and we have not come into his radar so much as of today. But that the fear is that if this comes into thing in his radar, what actions he might take, what kind of tariff he might put, and but again, so it's the trend is not reversing. Again, I think the one fear, the legitimate fear, is that there is something called as Inflation Reduction Act, is a regulation brought about by Biden administration, which Trump might reverse. He's basically said stop all the payments, and that is the concern. Over there also, we feel it is not possible to reverse. A lot of these contracts are many year contracts, and in the court of law, it's not going to be possible to reverse that. But incremental funding can stop because of the uncertainty created.
Okay, so just to wrap this up, for that investor who has perhaps put his money in Waree Energies and has seen a big fall, what would your advice be to them?
See, I will not address questions specifically about the company. You need to consult your investment advisor about what action you should be taking. But I will speak a little bit on the industry and what our thought process are and where our conviction lies. I believe that the factors that have led to this inflection point in this industry are pretty much intact, whether it is technological uncertainty, whether it is the unit economics, whether it is regulatory tailwinds, at least in India, they are all intact. Scalability of business model. What we are talking about is probably a little bit of a slowdown in the adoption in US, if at all, from the actions being taken by the Trump administration. Over there also, I feel it is not so easy to reverse what has been done in the past, and probably there might be incrementally, because of uncertainty, the investment might slow down a little bit for the current year. But I'll just give you one example, and that I think should make it very clear. The Inflation Reduction Act that Biden administration brought in gave a lot of tax subsidies and capex subsidies to people, to companies putting solar plant in US. Now, because of those subsidies, the returns for the IRRs were very high. As in, you could in a 1 year payback. That is like fantastic payback. But even if those benefits go away, your payback period would still be 2.5-3 years. Now, under normal circumstances, that is a fantastic payback. In a 3-year time frame, if you can get your money back, that still remains a very fantastic payback period. So, despite the benefits going away, if the economics remain favorable, then that trend is not going to change. It's only a bump in the longer term journey of the energy transition that we are witnessing. So the trend is not over. I believe over the next 5 years, we are going to witness J-curve adoption of solar technologies all across the world.
Okay, so you don't think that, okay, that trend is there and there's a J-curve, etc. But you don't think some of these stocks were not just priced to perfection, but there was nothing left on the table for investors, valuations are sky high, there's so much hype in the stock. So that could also be one of the reasons why there's huge correction.
No, so clearly from a near-term perspective, you are absolutely right about it. But after a valuation adjustment, if the trend is still intact and the valuations have now become reasonable, then there is no cause for you to say that this will go back to whatever valuation you think. I'll give you an example way back from my 2003-2008 cycle days. there was a company we had bought, and it was a PSU company, BEML, Bharat Earth Movers. That stock went, when we bought it, it used to quote between 15 and 20 rupees, and that stock went to 240 rupees in a matter of 3 years, from 2002 to 2004. And then, of course, that government changed and there was a crash, and that stock fell almost from 240 rupees to 80 rupees.
Wow.
That is the kind of damage we saw. But the cycle was very much intact. Even despite the change in government, the earnings growth continued. In fact, it actually got accelerated in UPA 1. Now, when that happened, the companies bounced back, earnings bounced back, and that stock went from 80 rupees all the way to 1600 rupees.
Wow.
Now, that was possible only if that trend was intact, the earnings growth was intact. And I do believe that this is but a minor bump in the larger trend. And that is why I am of the opinion that this is not the time to be exiting these stocks.
Okay. Ravi, I must say that it's been over an hour we are chatting, but I have learned so much in the last 1 hour, and it's really an honor to sit next to you and understand from you and pick your brains on how to invest. But just some final thoughts, right? Because I do know that you've had a very rich career with where you've been associated with, say, Rakesh Jhunjhunwala, with Utpal Sheth. You've worked with them for years. What has your biggest learning been from veterans like these?
First of all, I consider myself very lucky to have worked with such legends in early part of my career. I think they played a big role in how I think about things. I think opening up the mind about the opportunity, opening up the mind about risk taking. Equity is risk, so you have to be taking a calculated risk. I think one myth most people have is, and it's taught in colleges, so it will not be any different. High risk is equal to high reward. I actually believe that's not true. It is low risk is equal to high reward. Where the perceived risk is high, but the actual risk is not there, is where you make the maximum return, where your mind is prepared and it understands that what the risk market is thinking is actually just not the case, is when you make the maximum money. Like, for example, we just spoke about the solar, where perceived risk is very high because of the Trump, because of the commoditization, because of China. Everything is making the perceived risk is very high. But if the actual risk does not pan out, then this is where you will probably make the maximum money. So again, coming back to what I've learned from Rakeshji, I think the number one thing I say is he was a tough boss. So he made sure that we had independent thought process. You cannot parrot what somebody else is saying. You have to justify what you are saying with your own rationale. You have to be on top of the numbers that you speak. You cannot be rattling out numbers which are factually incorrect. He had very low tolerance for that. Because of his low tolerance, I think somewhere deep down we were all so scared who were all learning under him, that we wanted to be absolutely sure about what we speak in front of him. So we used to spend a lot of time in getting that right. And I think that particular habit helps me even today.
So
I better be sure.
How long did you work
with him? I worked
with
him for 5 years.
And directly, used to report to him?
Yeah, I mean, Utpal Sheth was my immediate boss, but of course, the ultimate boss was Rakeshji in that office.
And between Rakeshji and Utpal Sheth, what was of course, you said he was a very big, he was very particular and he had an independent thought process that all of you had to have. What else? I mean, from Utpal, what did you learn?
No, I think he is one of the most brilliant minds in our industry, and the art of negotiation, the use of frameworks, various different kind of frameworks in investing. I think I've learned a lot from him, and honestly speaking, I can barely even be 5% of trying to replicate him. But I think when to apply what framework and how to open up your mind to what the possibilities are is, I think, that I've learned from him.
Okay, interesting. So, you what I really admire about you is how in-depth your research is. And I'm sure it's come after years of, doing the same thing over and over again, learning about companies, etc. Are there any resources any podcast that you listen to, any international, or global market veterans that you listen to, any books that you like, anything you would recommend?
So there are tons and tons of resources in today's day and age. It 20 years back it was not so bad, but today it is fantastic. In fact, I think there is an overload. So picking actually the right ones, maybe listening to your show is the right thing to do. I think that's the beginning of the journey. But I think I would say do listen to what Professor Ashwath Damodaran says about valuation. I think he does provide a fantastic framework to think about valuations. I mean, I will not give too much credit. Or rather, I don't want his opinion on what the markets are today. That's not what I'm looking for. But his ability to connect the narratives and the numbers and how to put that in a model, I think that is fantastic, that I learned from him. Just reading Berkshire Hathaway newsletters or Michael Mauboussin, his research papers, his ability to connect theory and practice is legendary. And the common sense that is, Berkshire Hathaway's newsletters are full of common sense, which is a great, you need to finally be very rational and commonsensical about things in the financial world. But because it's easy to get carried away on both sides. You can get greedy and you can get panicky. So keeping your thoughts very rational and balanced is a challenge. And that's why you keep going back to these readings. In terms of books, there are again many books. I can never list out all of them. But one book which Warren Buffett says that changed, or rather one author, which is Phil Fisher, he changed his view about him from being focused excessively on trying to buy something worth $1 at 50 cents to buying a business that is worth $1 can grow to $3, $5, $10 over a long period of time. So basically, buying a better quality business over buying cheap is something that Phil Fisher taught him, according to him. And his book, Common Stocks and Uncommon Profits, is a Bible in that sense. Then I think for any newcomer, Peter Lynch is a must read because he makes you fall in love with the subject, with the markets. I think that is most important. If you start with Intelligent Investor, most likely you will hate it and never read a book again. So you have to reach the Intelligent Investor stage much later in your journey. Then I would say, the most difficult aspect about investing is the behavioral aspect. I mean, how you behave in situations. You might say, if market falls 30%, I won't do anything. But when it actually happens, and then the whole world is questioning what's going to happen. There was a time in 2008 global financial crisis where there were countries defaulting, forget companies. And it was like we were looking into a deep down, black hole abyss. So we didn't know what the world is going to see tomorrow. So when that kind of a situation happens, where there is no framework available for you to think how to think about this situation, or for that matter, COVID also. We just brought the whole world to a standstill. It had never happened before. And we were so living in such an interconnected world. So when such kind of things happen, and there is no framework for you to think rationally about it, at that point of time, you have to rely on your emotions. You have to rely on your, the history of the markets, that, okay, come what may, if not this, some other thing has happened. World War had never happened. World War II had probably never happened. So many things have happened which have never happened before, and they will keep happening. But at that point of time, your faith in equities, your faith in belief in the companies and the valuation that you are paying for it is what is going to hold you good. So you have to absolutely focus on that aspect. So coming back to the resources on that front, there are some books which hold me in good stead over there. Reminiscences of a Stock Operator. It takes you through the emotional roller coaster of a trader, and where you realize how painful it can be. You can go bust. You can be the king one day and you can be a pauper the next day. So that is an aspect which is very difficult to teach. Then
you said
reminiscences of a stock operator. Then there are books about crowd psychology, manias, panics, crashes, about the history of the markets. Then there are books like Howard Market's Mastering the Cycle. It tells you how usually the market cycles function. Again, these are all great frameworks from where you can pick up how to think about a market. So yeah, I can never pin it down to a particular book or resource.
No, but quite a bit. This is quite a bit that you shared with us.
In terms of podcasts also, there are really good podcasts out there. I love to read whatever Morgan Housel has to say. I love to read what Shane Parrish of Furnham Street has to say. I listen to podcasts by Nikolai Tangen, which is he's the CEO of Norges, and he regularly interacts with the top business leaders in the world. And there's a plethora of his podcasts available. Then there are some, of course, political podcasts and all, but they are not necessarily my everyday thing. But yeah, tons of good content out there which one can learn from.
Wow, this is amazing. Thank you so much for sharing. And one last piece of advice to every young investor who's never seen a bear market and now seeing about 20-30% corrections in their portfolio. What's your advice to them? Do you buy? Do you sell? Do you hold?
So I think what the new investor need to first understand is, are they investors or are they traders? If they cannot see 20-30% kind of drawdowns in their portfolio, they don't have any right to call themselves investors. So if you have come to the equity markets to create wealth, then start thinking in terms of creating wealth, and not you think you can go from 100 to 10,000 without any kind of a correction, then you are living in the biggest folly. So you have to develop that muscle memory, develop that gut, strengthen your gut to take into stride these kind of correction, and yet be positive about equity markets from a longer term perspective. And I think that would be my advice, that don't be traders, don't be day traders, absolutely. Be investors, think long term, and buy something that you understand at valuations that you understand.
Okay, Ravi, we have completely run out of time. I think we've gone on for almost 1.5 hours. It's been the longest I've chatted with anyone, but it was an absolute pleasure. Thank you so much. And I hope, you've done 20% CAGR since inception. I hope you continue to maintain that despite the ebbs and flows of the market. Thank you for being with us in the show.
Thank you so much.